Welcome. You are now linked to your telecom retirement.
Hey, how are we doing today? Can you believe it's the 100th episode? I don't usually get big on those things in terms of I'll give you for instance the production company that puts all the podcast stuff together said you should do a retrospective. I hate those things. I'm sorry. Nothing against them or anything else or whatever. Acknowledging it. 100 episodes, 2.5 years, because I did almost 2 years of, or just about 2 years worth of every week, which was a grueling schedule. It really gave me a definite appreciation for people like Joe Rogan that does hours a week of just talking. And granted, it's interviews and things of that. But anybody that comes up with a topic once a week, once every other week is to be commended. It's a big deal. It's kind of funny. I was thinking about it this morning. Is one of my, or used to be one of my favorite podcasts, was Mike Rowe's The Way I Heard It. And originally the first 100 and something episodes was he came up with these the rest of the story type stories for, where there'd be a twist at the end. You're trying to figure out the twist and, oh, that's John Wayne or whatever with that. And for like the first year and a quarter, he went out every week. And then with the 17 other projects he was doing, it took him probably 4 years to get to 100 at that point. And now it's kind of morphed into an interview show that's 2 hours long, as opposed to he was like the number one, what they consider short form podcast on the internet pre-pandemic, which was less than, I think, 15 minutes. He was the number one guy. He owned that space. Now it's 2 hours. I don't know what his numbers are, but it was just fascinating. So 100th episode, if you're new to the podcast, you've got 100 episodes to go through and pick and choose, find topics that might be of interest to you, because we try to deliver information that gives you a leg up on the rest of the financial world, especially as it relates to telecom with 9X Verizon, Verizon, AT&T specifically. So today I want to talk about the high interest rates. Oh my gosh, interest rates are so high. And what are we going to do about it? And if you watch, it's mid-July, I believe, right now as this is being released. I'm recording it sometime in June. And people are going bonkers because the Federal Reserve won't lower interest rates, and it's terrible, and life is over. And we're driven by the news cycle. Is whatever the news tells us, we just follow. I was watching, I won't mention the network. I happened to be meeting with a client at a Dunkin' Donuts this morning, and they had the news on full blast. I won't tell you what channel it was. I won't tell you what candidate they support, but it was ferociously clear which candidate they supported on a news program. And that was just shocking. So the news feeds us a lot of information that I don't know if they're really even aware that they're feeding it to us this way. I think they're just blissfully unaware. They're just trying to sell airtime. And so the media builds up this whole thing about the Fed won't lower the rates, and the markets, and gigantic air quotes, are concerned with that. Is it a big deal to you and me? Is it really a big deal to you and me, or is it an advantage? Obviously, there's a huge disadvantage if you're going to buy a house or buy a new house or refinance your house. It's not that great. But outside of that, is it really that bad? So I want to talk about three things that high interest rates do that actually kind of helps us out right now. So the first one is kind of the most technical. We'll start with that one, that you can kind of put that one away and go, yeah, we'll let Dennis worry about that. Is there's supposed to be a competition within the financial markets for your money. There's supposed to be a competition. And if you go to business school and you take finance classes, you'll learn about this competition between the risk-free rate of return and the stock market and bonds. And there's kind of this play as money flows from very short term to bonds to stocks based on how the average investor feels about the prospects of that going forward. And we've had a situation over the last 20 years, 20 plus years, 22 years maybe, where interest rates have been artificially low, definitely since 2008. They were set artificially low all the way through 2022. That has really forced a lot of money into the stock market. So some of the gains that we've seen over that time span were purely because there was a lot more dollars chasing very few shares of stock. And that's not the case right now. And you're really seeing that develop is if the stock market and the economy continue moving forward, even though we have this bigger competition, because you can go out and buy a CD, at least a month or so ago, paying 5.25% if you really shop it around at a local bank. That's a big deal. Or do you want to take risk money in the stock market? And what we're seeing is the stock market is still moving forward, even though, and I haven't checked the numbers to see if money is being pulled out to go in there, but there's definitely that attraction, especially to individual investors. When I talk to people, they're always talking about, is it really true I can get 5% in a CD? Yes, it really is true. At least at that time when I'm recording this. And you're seeing that the stock market is still moving forward. Now, it's not moving forward as well as you might think. And this is a little quirk that I want to talk about, just spend a minute or two on this, is as of the recording, or as of, I'll say mid-June was when I actually went and looked at this, was mid-June, the stock market was up around 15-16%. And you've probably heard of this company called Nvidia. It's a chip company. I remember Nvidia when it was a graphics chip company back in the 90s. If you wanted a really cool computer, you had to buy their graphics card or a computer with their graphics chip in it, and it cost a fortune more. It was a big deal. And I didn't even know they existed after that. I figured they kind of moved on or whatever. And then all of a sudden they pop out of the woodwork a couple of years ago to the average investor again. As this AI chip development company. They are one of the top 3 companies in the world right now. Their stock has something like tripled in the last year or year and a half, continues to grow crazy. When I was looking at this mid-June, and it's hard to tell because of the way the S&P 500 is calculated. It's calculated on a day-by-day basis. But just rough back of an envelope calculations, about half of the gain in the S&P I figured was attributable just to that one stock. Because you look at the S&P 500, you say, oh, it's 500 companies. That's what the 500 and S&P 500 means. It's not that easy. The top 10 companies are over a third, almost 40% of the value in the top 10 companies. The top 3 companies, which is Nvidia, Apple, and Microsoft, are over 20% of that average. Over 20% of what you're buying when you're buying an S&P fund is 3 stocks. And I find that amazing. I find it also fascinating going back, and we'll talk about the 80s in a second. You go back 40 years, 1984. What are the 3 hottest companies in 1984? Microsoft, Apple, and Intel, which is a chip company. It's 40 years later. Who would have thought it'd be Microsoft, Apple, and a chip company? So outside of that, you're seeing rates of return not be spectacular, is somewhere between 2 to 7% on the rest of the market is really where it is. But those dollars coming out of the market is very healthy for us moving forward. We need that competition. And it's very important to make sure we have that competition within the investment markets so that companies can, so we get a true value of what's really going on. You don't want to overbuy. You don't want to have a situation where like crypto got crazy. Remember when NFTs, which was 2 years ago, 3 years ago, Tom Brady had his Tom Brady NFTs, and you're going to make all sorts of money by buying my NFTs. He's on commercials on TV. He loses hundreds of millions of dollars on NFTs because they don't exist. Same thing here. We don't want money pouring into the stock market and overvaluing it just for no reason. So high interest rates temper that. They slow that down. The second thing it does for us is it puts more dollars in our pockets. And you go, yeah, well, I know that because interest rates are higher. But it's not just about that. Is we've been in a strange situation over the last 15, 16 years since since the last financial crisis, where interest rates on very short-term instruments has been near zero. Is you made like 0.1% on your money market accounts. Money market accounts back in the 80s used to pay 7%. The economy functioned with a money market paying 7%, by the way. It functioned fine. If you're under the age of 45 or 50 and can't believe that, it functioned fine. The stock market did very well. The economy grew actually probably at a faster pace than it's doing today. Uh, Everything was okay. And a money market account was paying 7%. CDs were paying over 8 at the time. And I'm not talking 81 and 82. I'm talking 85, 86, 87. That realm, you were still seeing those types of rates of return. But when interest rates are near 0.1%, and inflation is, let's say, 2%, if I put $1,000 into the bank and a year later I take it out and I go to spend it, I'm not going to be able to buy $1,000 worth of stuff anymore, am I? Because everything's gone up by about 2%. It's worth 1,020, and I've got $1,000.62. And you go, oh, wait a second, I'm losing money. And that's called what's your real return? You're actually losing money on a real return basis. Is on an inflation adjusted basis, you're losing money. And very short term accounts, less than 1 year CDs, bank accounts, money markets, things of that nature, shouldn't pay much more than the inflation rate at all, ever. And what we're finding now is, yes, they are, and it can actually put more money in our pockets. So, if you look at interest, inflation's running about 3%. Even if you factored in taxes, in terms of you had to pay taxes on the interest. And if you have a lot of money in CDs, money market, bank accounts, you noticed last year, uh, you got a big tax surprise, because all of a sudden, for years, we've forgotten what that interest looks like. And now all of a sudden we're receiving it. It's a great deal. We got to pay taxes on it. Even if the tax was 25%, if you're making 5%, and inflation is 3, you're still ahead of inflation. You're actually, your dollars are growing, and that's a big deal. That's something that hasn't happened in a long, long time. Back in the 80s, when money markets were at 7, inflation was like 5.5. You were actually just barely keeping pace after taxes. We're in a situation right now where investors, just by having money sitting around, is actually gaining and providing wealth. So that's a big deal. But the third reason is a bit more long term, and this is the one I want to spend some time on. Uh, and I've been talking about this. If there's any clients listening, you're going to say, "Oh, I remember this talk." I've been talking about this for well over a decade. Is low interest rates make stupid CEOs, and that's just a fact. Is low interest rates guarantee you a bad CEO of your corporation, regardless of what that corporation is. It creates a situation where a CEO does not have to be smart and innovative in order to be successful. Now, let me tell you what I mean by that. Is interest rates have been at historic lows up until last year. So a company, in order to make the stock price grow, and that's really what a CEO's job of a public corporation's job is ultimately, or at least that's how they view it. It's not how I view it, but that's how they view it, is increasing shareholder wealth. And you can do that a couple of ways. You can invent the iPhone. Son of a gun, it goes up. You can invent a chip that can handle artificial intelligence. You can invent a new way for shopping, whether that's Amazon or Walmart or Woolworths or J.C. Penney, as all of these companies succeeded in their time based on innovations they made. So you can innovate, or you can play accounting tricks. And one of the accounting tricks that has been ridiculously popular from about 2009 through 2022 is to borrow money, because it costs next to nothing to borrow, to run the operation, as opposed to utilizing the cash in the business to run the operation. Let cash accumulate And you've noticed this if you read the financial press at all over the last 15 years or so, especially a company like Apple. Apple is a company that's always accumulated a lot of cash. They make a boatload of money and they can't spend it fast enough. They can't innovate beyond what they've done. So they accumulate a lot of cash. They have like something. Don't quote me on this, but I want to say they have over $1 billion. It might be over $2 billion in cash at this point. So with these companies, they accumulate this cash. What's the best way to spend that money? Now you can take a risk and invent a new product, and that might be helpful to you. Or you can buy back the company stock. You can just buy some stock back. And you say, well, who cares? Well, what that does is the way we value corporations is what's called earnings per share. Well, earnings is fixed. Earnings is the corporation makes X number of dollars in profit. But if I can buy back and make shares disappear, all of a sudden the number of shares is less and my earnings per share goes up, sometimes substantially up. What's the smarter move if I'm a CEO in 2015 to spend money on R&D on this new invention, or do I just buy back stock and I get the same success bump on earnings per share, but it didn't cost me anything. There's no risk. So all of a sudden, part of what we've potentially seen over the last 15 years, there's always this continued argument of CEO pay is too high. They've done a good job of increasing shareholder wealth. They've just used accounting means to do it. And now they can't. So what does that mean? In the short run, might not be pretty. These companies are not going to be able to borrow money to buy back their own stock. It's not going to be financially feasible for them. What that means is you're not going to see them innovate. So there may be companies that stagnate. There may be CEOs that are fired in the next 2 to 5 years because they've stagnated. Here's what it is going to mean is we're going to see a shakeup and we're going to force management teams of these companies to innovate. They don't have a choice. They're competing against Microsoft and Nvidia and Apple and Amazon and Google and Facebook. These are the largest companies in the world. They don't have a choice. If they want dollars to come into their company, if they want to see shareholder growth and keep their jobs, they're going to be forced to take risks and innovate. And all of those other companies that I just talked about at one point innovated and brought us to a successful place. Is think of the world without Google. Think of the world without Facebook. Think of the world without Apple. I would die if Apple didn't exist. My gosh, I am so invested in their entire line of products. I'd be in trouble. And you look at it, even Nvidia is, where would we be without that? We haven't seen that yet. We're on the cusp of what that might mean with AI becoming more integrated into how we do things. And at some point I'll have a whole podcast on AI. It's not exactly what we think it is. Sneak peek is I'm always amazed at people at companies that continue to make the same mistake over and over and over again. And they say, we're going to use AI and develop a method to fix this mistake. And I look and I go, or you could use actual intelligence and you could have fixed it 10 years ago. Why didn't you fix it then? Because you could have fixed this problem. It was a fixable problem. It was a customer service issue or whatever. It was a fixable problem. And now suddenly AI is going to fix it. No, it is not. It's going to take actual effort to fix it. But I digress. All of that innovation is being pent up in the other 490 companies in the S&P 500 that hasn't been tapped yet because these CEOs haven't been pressured. So what we're looking at is things could be rocky. They could be, we don't know, within the stock market in general, within the economy. But I keep thinking, man, what happens on the other side? I think about, I've lived in the city of Taunton, Massachusetts for 30 years. And 30 years ago, You think about, well, things we take for granted today. 30 years ago, I can't remember the name of the company. There was a company that built chips for the military. That was their job. And it was gallium arsenide chips or something like that. I forget um, what the process was, but their manufacturing plant was 10 minutes from my house. I drove by it frequently. There's an industrial park near my house, and they were one of the big companies, and it was a big deal. And the U.S. government funded it, and then they got to a place where the technology was allowed to be released, and you don't own a cell phone, tablet, whatever, without the technological advancements of companies like that. They were one of many companies that did it, but it was a big deal. That type of innovation took us from the junky StarTAC flip phones and the Nokia 3310 that you could not break, whatever they called that. It was just a blonky phone. Took us from that to the smartphones of today, the tablets of today. Even something as silly as my Kindle, where I read just about everything on my Kindle, in terms of books. All of that was because of innovations by these little companies. Again, Nvidia was to some extent, a podunk graphics chip maker. They were never going to make $1 gajillion making graphics chips. They just weren't. But they had technology that they could make things better than other people. So that innovation is what excites me. I look at the next 10 years in our economy and I say, wow, these companies are being forced to innovate. The economy has now forced them to innovate. And as much as I would like interest rates to go down, personally, because we're out of balance, and we're definitely out of balance, is again, we're not supposed to make a real return. Short-term investments are supposed to be zero-sum games, and we're actually gaining. That shouldn't be, and I worry about that. The flip side is forcing these corporations to innovate is going to make such a big deal for tomorrow. It is going to really make a big difference in our lives and our pocketbooks in the future. So that's what I have. Don't worry so much about when you read in the news. If we have anybody, I guess we read the news on our phones these days, or you're listening while at the Dunkin' Donuts and they're talking about the economy, or on your drive-in and they're talking about interest rates. There's good and bad. There's good and bad to high interest rates. There's good and bad to low interest rates. Don't always believe what they're telling you. Good interest rates are helping us right now. They need to go down eventually, but they're kind of giving us a little bit of a boost, and we should take that boost. Again, if one last thing with my production company, if you want a retrospective episode, shoot me an email, Dennis@successfulmoney.com. Shoot me an email. If I get a lot of responses, I'll do one. I'm not a big fan of them. That doesn't mean I shouldn't do it. I want to deliver what people want to listen to. So if you want kind of a retrospective talking about different topics and things like that, I am definitely willing to do that. But let me know one way or the other. Reach out. Again, if you have questions, use the same email. That's what I'm here for. And if you have ideas for future shows, definitely reach out. So thanks for your time today, and stay safe out there.
Thank you for listening to Your Telecom Retirement with your host, Dennis O'Keefe. Please click the follow button to be notified when new episodes become available.